Hey everyone, welcome back to the channel. Today I am starting a new series on high dividend yield stocks. I will be sharing my current watch list with you, as well as talking about the criteria used to include stocks in the watch list. I will go over who this watch list is best suited for and how to best utilize the information I present. We will wrap up with a quick review of the recent performance of the stocks in the watch list. Let's go! Let's take a look at the 28 stocks currently in the watch list. You will probably know most of them, but there may be some new names here for you to do further research on. Number 1 is AMGN, which is a healthcare stock. More specifically, they are a biotechnology company focused on various therapeutics. Currently, they offer a 2.88% dividend yield. Number 2 is Bank of New York Mellon, which is an asset management and custody bank that currently offers a 3.17% yield. Number 3 is Bank of Montreal, which, as the name suggests, is a Canadian bank. They currently offer a 4.38% yield. Number 4 is Bank of Nova Scotia, another Canadian bank currently offering a juicy 5.57% yield. Number 5 is the Canadian Imperial Bank of Commerce. If you're wondering, no, this isn't a Canadian stock watch list, but Canadian banks happen to offer some of the best yields on the market. Canadian Imperial Bank currently pays a 5.18% yield. If you're new to my channel, please hit that like button to help promote this video, and subscribe to be updated of future videos. Number 6 is Cisco Systems, which is a communications equipment company currently offering a 3.35% yield. Number 7 is CVS Health Corporation, which is a healthcare provider and a servicer as well as a retail chain. They currently offer a 2.95% yield. Number 8 is DTE Energy Company, which is a broad utility with exposure to gas and electric energy. They currently offer a 3.45% yield. Number 9 is EVRG, another utility. They focus on electricity generation, transmission and distribution services. They currently offer a 3.86% yield. Number 10 is General Dynamics, which is an aerospace and defense company. They offer a 2.95% yield. Number 11 is Hasbro, which develops toys and games. They currently offer a 2.92% yield. Number 12 is Huntington Bankshares, which is a regional bank in the Midwest. They currently offer a 4.97% yield. Number 13 is JP Morgan Chase, which is a large diversified bank, and they currently offer a 3.05% yield. Number 14 is Lockheed Martin, which is another aerospace and defense company. They make the fancy military jets you see at air shows, amongst other things. They also currently pay a 2.85% yield. Number 15 is Alliant Energy, which is an electric utility and currently offers a 2.89% yield. Number 16 is 3M Company, which is an industrial conglomerate with many products in their catalog. They currently offer a 3.40% yield. Number 17 is M&T Bank, which is a regional bank currently offering a 3.78% yield. Number 18 is Northern Trust, which is a large asset management and custody bank, offering a 3.01% yield. Number 19 is PepsiCo, which sells Pepsi amongst other types of beverages. They currently offer a 2.84% yield. Number 20 is Principal Financial Group, which is an investment management company that currently pays a 4.5% yield. Number 21 is Rogers Communications, which offers wireless communication services, cable TV, and internet services. They currently offer a 3.26% yield. They are a Canadian company, FYI. Number 23 is Southern Company, which is the parent company of many regional electric utilities, mainly in the southeast United States. They currently offer a 4.28% yield. Number 24 is State Street, which is another large asset management and custody bank, currently offering a 2.95% yield. Number 25 is Toronto Dominion Bank, which is another Canadian bank, and currently offers a 4.46% yield. Number 26 is Truist Financial Corporation, which is a regional bank currently offering a 3.88% yield. Number 27 is TC Energy Corporation, which is an energy infrastructure company. That basically means they develop projects around energy creation, like gas pipelines and various storage facilities. They currently offer a 5.67% yield. And number 28 is US Bank, which is a large diversified bank currently offering a 3.89% yield. You may be wondering how these stocks found their way onto my watch list. Did I just pull random names out of a hat, or just find a bunch of high-yield stocks? Neither. There's a set of rules I use to narrow down this list of stocks based on criteria I believe identify high-quality stocks. Let's take a minute and talk about this process. I used 11 unique filters, some very simple just to narrow in on dividend stocks, and others more specific that I believe help weed out weaker companies. Let's go over all of them. First is the exchange the stock trades on. I have this filtered for either NASDAQ or the New York Stock Exchange because I want stocks that are easily accessible in popular brokerage accounts. Next, I filter for companies with at least a market cap of $10 billion, because I think larger companies are safer investments compared to smaller companies. Next, stocks that pay a dividend, because this is a dividend watch list after all. Next, stocks with a current dividend yield of at least 2.75%, because to me that is a sufficiently high enough yield to initiate a position for a high yield portfolio. Next, a payout ratio below 100%, because I want to invest in companies whose earnings are higher than their current dividend payment. This offers a level of safety. The dividend stream will continue and possibly grow in the future. Next, a positive 5-year dividend growth rate, because I prefer stocks that are increasing their dividend payments. It's hard to find many high-yield stocks with high dividend growth rates, and if you do find one, I wouldn't expect that growth rate to continue indefinitely. A high growth rate is very hard to sustain, especially for high-yielding stocks, which typically tend to be mature companies that aren't growing their revenue quickly anymore. Next, a wide or narrow Morningstar economic moat, because I think this is a useful metric to weed out lower quality companies. Next, an exemplary or standard Morningstar stewardship rating, because I like companies with good or excellent management teams. Next, an S&P quality rating of B+ or higher, because this is another way to identify higher quality companies. This rating evaluates companies on their earnings and dividends and assigns them a letter rating. A rating of B+ or higher is associated with above average companies. And lastly, a positive 5-year revenue growth rate and a positive 5-year earnings per share growth rate, because I prefer companies that have both top and bottom line growth. Companies can manipulate their financial reports to give off the illusion they are performing better than they truly are, but it is very difficult to manipulate both the top line and bottom line growth. Hence, if there is a disproportionate difference between the top line and bottom line growth, you need to figure out what's going on in the business causing the discrepancy. Okay, so now that you've seen my watch list and know how it works, what can you do with this information? You can use this watch list to pick individual stocks to review for inclusion in your portfolio. If this is your intention, I would like to suggest a method for choosing which stocks to review first. A popular valuation method, and one that I have used in the past, is the dividend yield theory. If you're unfamiliar with this method, it's quite simple. The theory implies that quality companies that pay a dividend, over time, revert to a normal long-term average dividend yield. Therefore, if you compare the current dividend yield to the long-term average dividend yield, it can tell you if the stock is potentially undervalued, overvalued, or fairly valued right now. Let's take a look at each of the stocks on my watch list compared to their 5-year trailing dividend yields. If the current dividend yield is higher than the trailing yield, it implies potential undervaluation, and vice versa. As you can see, many of these companies are undervalued, but some are overvalued based on the dividend yield theory. I would start researching the undervalued companies first and try to figure out why they are potentially undervalued. Is the stock price reflecting a deteriorating business, or has there been an event that negatively impacted the stock price, but one that is not material to the long-term profitability of the company? This will require you to make a judgment call, and it helps if you have a good understanding of the company and the industry they operate in. Please note that I keep using the word potential, because there may be a reason why a stock price has declined, in which case this valuation method is useless. You should always research to understand what's going on with the business. Otherwise, you're not investing, but merely speculating, and that can lead to terrible returns. So what if you don't have time to review 28 individual companies, or you aren't comfortable making judgment calls on how healthy a company is? Let's be honest, it's pretty difficult to fully comprehend 28 unique business models and multiple industries. This is the main reason why index funds and ETFs are so popular. You buy a basket of stocks and don't need to spend a lot of time understanding each individual piece thoroughly. This watch list could be used just as such. Invest a little bit in each stock, and over time, the good returns should outweigh the few bad ones. The criteria used for the watch list should narrow down the final list of stocks to safe and stable companies, but it's always possible that a few bad apples slip through. Also, things could change in the future. Maybe a company is financially fit at the moment, but the economy shifts and they lose their footing. That's the risk you take as an investor. A high dividend yield strategy is best suited for individuals seeking to create a passive income stream. Don't expect this strategy to outperform the broad market or a growth strategy. If you're younger and your main objective is to grow your portfolio value, this is probably not the best route for you. Take a look at this historical return comparison between a high yield ETF and a growth ETF from Vanguard. Since 2007, the Growth Fund has achieved almost double the return of the High Yield Fund on an annualized basis, 11.52% versus 6.41%. But take a look at the income stream each strategy has produced over the same time period. As you can see in the chart, the high yield blue bars are more than twice as large as the growth red bars. So the deciding factor here is what is most important to you. Are you looking to grow the market value of your account, or are you seeking to generate an income stream? This is not to say that a high yield strategy won't grow your market value, but odds are it's not the best method for capital appreciation. Regardless whether the strategy is ideal for you or not, there is the option to allocate a small percentage of the portfolio to high dividend yield stocks That will generate passive income that you can use to purchase more high-yield stocks or growth stocks or whatever investment strategy you pursue. And if the high dividend yield strategy isn't right for you today, it may be more appealing as you near retirement, so it's still a useful approach to be familiar with. Let's see how the stocks on my watch list performed during November. Collectively, the return for November for these 28 stocks was 13.04%, compared to the return of SPY, which is an S&P ETF, of 10.88%. And Vanguard's High Dividend Yield ETF, ticker symbol VYM, return of 12.26%. The best return for November was 26.95% from Principal Financial Group, with the other financial stocks doing quite well for the month. The only position down for the month was Alliant Energy, losing 4.85%. The average yield of my watch list is 3.73%, versus the S&P yield of 1.8% and VYM's yield of 3.68%. So had I invested in all the stocks on my watch list, I not only would have beaten the S&P and VYM in November, I also would have generated more passive income than the S&P and been in line with VYM. I don't imagine this watch list will outperform the S&P or VYM in total return every month, but it should generate substantially more income than SPY and track VYM. If you guys have any questions or would like to see additional information not included in this video, please leave me a comment below. That's it. Thanks for watching.